years, because of you do deal with a lot of clients who are, in a dark hole when it comes to debt and their debt situation?
Sam, yeah, interesting question, and it obviously brings up a number of different scenarios for me, because we have someone who's in a position to meet their monthly living expenses and debt repayment, but just in terms of wanting to be financially more stable and having that cash flow, or wanting to build a nest egg, I now want to set about settling my debt and obviously becoming debt free. And obviously the scenario for someone like that is a little bit different, and the approach that I would very much encourage someone like that to follow is obviously, first and foremost, you need to look at your budget. So you need to look at what you earn, and then you need to look at your expenses. But with a critical eye. What I've seen work and work very successfully in terms of the customers that we assist is when you're willing to do what you need to do in order to achieve the end result. So when you're looking at your expenses especially, it's identifying those things that's more a want as opposed to a need, and then making a conscious decision to remove that from your budget. That will then leave you in a position where you can now accurately say, this is the amount that I have available on a monthly basis to service my debt or reduce my debt. Then have a look at what your debt actually consists of. So I've got a home loan, I've got vehicle finance, I've got a credit card, I've got personal loans. Look at how much you owe on each of the individual loans, as well as what the interest rate is on all of those loans. Then a very strategic approach in terms of tackling the loans with the highest interest rate, as well as the ones with the lowest balances first. Because what then happens, it's almost like a ripple effect, Sam. If I owe, hypothetically, Woolworths 3,000 Rand, and I'm paying 500 Rand towards my Woolworths account, the minute I settle and say Woolworths is the lowest debt that I've got, the minute I settle that Woolworths account, I now have an additional 500 Rand a month, which I can apply to the next lowest debt. And that is what you do. You have to be very deliberate about it. You have to have your end goal in sight at all times, and almost have a book, and that's what works for most customers. So make it visible, make it something that you look at on a daily basis in terms of this is what I've achieved thus far. And as you're paying off one loan, you then take that funds and you then apply that to the next loan. And that is how you go until you fully settle your debt. Obviously, critically important then also to take the lesson with you as well, because as easily as it was to acquire that debt in the first place, it can happen again. So it's also about taking the lesson away and then obviously being very disciplined in your life going forward. Sam, we then also move into a different category of customer. And again here, we all know what we've been through over the last 2 years. And a lot of customers find themselves in very difficult situations due to loss of employment, loss of income, everything beyond their control. And you're now faced with a situation where your income is not sufficient to service your living expenses together with your debt repayment. No use running away from that. You have to approach something like that head on. Go to your bank, have a discussion with your bank, and see how they can assist you to better manage your finances to get yourself out of that situation. Number of different options that's open to customers in this situation, and all depending on the severity of the situation. I'll give you an example, Sam. So say for instance, the shortfall is R1,000 a month. An option that you can explore, a lot of the financial institutions grant what is called payment holidays. So that's where for a period, maximum is normally up to 3 months, you don't hypothetically have to pay your bond installment for 3 months. And you find that maybe one of your accounts, let's use an example, you hypothetically owe Woolworths 15,000 Rand. Your bond installment is 5,000 Rand a month. With that 3 months payment holiday, that will then enable you to settle Woolworths within that 3 months, freeing up that installment that you were paying Woolworths and inadvertently then solving your financial distress, because now you are in a position where your income is now sufficient to cover your monthly installments. Because what you will find on your home loan, even if you get granted a payment holiday, we know that a home loan, the term on a home loan is anything between 20 years to 30 years. So the impact on your home loan is minimal, even if you take it over your remaining term and the bank recalculates your installment. You might find you would pay an extra 100 to 150 Rand a month on your home loan installment, but you are now in a position where you're able to service all of your debt. Let's move then to a scenario where, let's say, your income or the deficit with your income versus your expenses is quite substantial, and we look at something like 5,000 or 6,000 Rand per month. Obviously, that's going to take a little bit more maneuvering to find a solution to get you out of that situation. But again, your first point of call should be your banker, because Standard Bank, I know for a fact, does it, and I'm sure most of the financial institutions do assist in that way as well. What is called a consolidation loan. So that's basically where we take all of your unsecured debt and we put it into a single facility over a longer term at a preferential interest rate, thus reducing your debt obligations. Anything, so say for instance, you were paying 15,000 Rand per month. By doing that, we can reduce your monthly debt obligation to 5,000 Rand per month. A saving of 10,000 Rand per month, and thus doing that, enabling you then to comfortably meet your living expenses and then pay that consolidation loan. It's even a bigger plus if you have a home loan that you can consolidate into. Because of the term of your home loan, obviously, we can even take you from a position where you have a huge deficit in the beginning to where you actually have a very good surplus after we consolidate into your home loan. Obviously, provided there's sufficient equity or value in your property for us to put all of that debt into your property. But yeah, there is hope out there, and there is solutions out there. It's just about asking for it.
Well, Bernice, thank you. I think you made and touched on some very interesting points, and I do love the fact that you're all about be proactive and just ask for help. And I think a lot of us generally don't really think that, we try and internalize or try and solve the problem within, what's already a messy situation. So it's very great to know that, we can approach our creditors and the bank, or, and find a solution without trying to figure things out ourselves. I'm going to move on now to talk about credit reports, because I think a lot of the time when we speak about debt, people are always, hyping up the importance of a credit score and, why you should look at your credit report. And I guess just starting from the beginning, what is a credit report? What is a credit score? Why do these things matter? How do they help people in their, in managing their finances?
Thanks, Aneo. Yeah. What is a credit score? A credit score is basically a 3-digit number. We know there's different credit bureaus, and some of them have multiple ways of scoring credit history. In general, the scores range from 300 to 850. A good credit score is normally considered around about 670 or higher. We all know as a society, it's becoming increasingly dependent on credit to make purchases and financial decisions. A good credit score is used for so much more than just getting a credit card or a loan. A credit score demonstrates your history of paying your debt to entities that loan out money. Before you can buy a house, a mortgage lender wants to know that you won't default on your mortgage. If you don't have a good credit rating, the lender will obviously consider it to give you a mortgage loan. Or if you do get approved for the mortgage loan, your credit rating affects your interest rate. So the lower your rating, the higher your interest rate. Many employers also now conduct credit checks as part of the hiring process. And if you haven't demonstrated financial responsibility, a prospective employer might be very hesitant to hire you. Thanks, Daneo.
Awesome. So a quick question on my side. You were speaking about a good credit score. It's anything from 670 and upwards. How does one going about establishing a good credit score, or how does one go about building a good credit score? Is it only about paying your debt on time and making sure you manage your debt, or is there any other thing that is involved to making sure that your credit score is good?
Hi, Sam. I think the first step that you need to take is obviously to your credit report. Just so that in terms of sharing with the audience, everyone is entitled by law to a free credit report from each of the major credit bureaus once per year. I'll share obviously where you can get, but you can request these reports at annualcreditreport.com. There's also several credit monitoring apps and services. A lot of them are free that allows you to track your credit throughout the year. So once you've got your credit report, the first thing you need to do is to check your report for any errors or inconsistencies. Remember, it's calculated by the credit bureaus using your payment and account history, but there could be mistakes on the report. You could pick up something like a late payment reflected on your bureau report, when in actual fact you've been paying your account on time every month. Or you could find an account reflecting 1 or 2 months in arrears, when you know you have made payment to that creditor. So that should be your starting point in terms of improving your credit score, is going to both to the bureau as well as that creditor to rectify the error on your credit report. The second thing is obviously outstanding debt. And that has a significant impact on your credit record. We've spoken about late payments, and we've also spoken about skip payments, which automatically will deteriorate your credit rating. Outstanding debt have a significant impact on your credit record. So pay off as much as you can, as fast as you can. Start with credit card accounts, as they usually have the highest interest rate. Also look at the gap between the amount you owe and the limit on your credit card, or it's known as the credit utilization ratio. For example, if you have a credit card limit of 20,000 and you owe 10,000 rand, your credit utilization ratio is 50%. A good rule of thumb that will increase your credit score is to keep your credit utilization ratio at 30% or lower. So, the more you pay off, the more you will obviously improve your credit score. Paying your account before the due date also increases your score. Closing off accounts after you've settled them will obviously reduce the number of active credit accounts attached to your name, and that in itself will improve your credit rating.
Oh, awesome. So I knew that obviously, a bad credit score, would put you in a disadvantaged position when you're trying to get a loan or, trying to get new debt. I did not know that prospective employees can use it, when they're hiring you. What is the logic behind that? Would it be more from a financial industry, or are you seeing more industries doing that when they're hiring prospective employees?
So, Sam, definitely primarily in your financial industries, but what could also be a red flag for an employer is hypothetically, just think about it, if your starting salary is, let's say, 20,000 Rand per month, but looking at your credit bureau, you owe in total unsecured debt 400,000 or 500,000. Obviously, that would raise a little bit of concern for your employer in terms of, number one, how long will you actually stay in your current employment if that's the level of debt that you've got versus your income? Also, when we think about fraud in the workplace, that's a very real thing that comes into play when an employer is assessing, a possible candidate.
Wow, I think, we generally don't think of, when we're applying for jobs, the impact of our financial habits, but that's a very real example of how sort of letting things get out of hand or being in a position where you're really struggling can actually start having ripple effects in areas of your life that you probably hadn't even thought about. So thank you very much for that perspective, Berenice. I think, one of the big things is, whenever we start off, especially like your first job, etc., and you're trying to look for ways to, build your credit score, because that's what people tell you. You want to buy a car, you want to buy a house, you need to have some sort of credit record. So I guess the question is, do you have to get credit card debt for a high credit score? How else can you improve your credit score without getting in way over your head, in an attempt, I suppose, to increase your or build a credit history? How can you avoid making mistakes that are actually going to land you in more trouble than what you initially were hoping to sort of achieve?
Yes, Danayo, interesting question. I think maybe the starting point for all of us when we find employment is that we open up a bank account. And obviously, we start transacting on that bank account. And as we transact on that bank account, we start building almost like a credit history for ourselves, just by the very nature of how we conduct our account. So when we're speaking about account conduct, we're speaking about, not having sufficient funds in your account to meet your debit orders, having no debit orders return because you don't have sufficient money in your account, making sure that your account doesn't go overdrawn. So already there, and when I'm saying overdrawn, meaning a debit order goes through, and sometimes the bank will allow that debit order to go through and put you almost in the red, meaning that there wasn't sufficient money in your account and it now pushes you into a negative basis. Once you start with conducting your check account well, you can then now start moving on to when you are ready, for instance, to purchase a property or to purchase a vehicle. And you will find that obviously based on the conduct of your check account, obviously subject to normal affordability checks and credit checks and all of that, you will then be granted that finance for a vehicle or for your first home. And obviously, that in itself, what you now starting to repay on your vehicle, starting to repay on your home loan, you then starting to improve and generate that credit score that we are talking about. Credit cards is not a bad thing, Danayo. All depends on how you use it. And you might find there's a lot of customers that we've got that has got a credit card with, say, a 1,000 Rand limit on that credit card. Because we all know, especially Standard Bank has got an awesome rewards program. U-counts where you earn points for every swipe. And obviously, the higher points is allocated credit card swipes. So you could have that credit card with a 1,000 Rand limit, still transfer all your available funds into your credit card in order to earn that reward points, and indirectly you still improving your credit score.
Awesome. So, Berenice, someone actually on the timeline was asking if we can speak about excess bonds, right? And I want to connect it with your credit score, because I do know that some people who do have excess bonds, they pay, more money than is required for the bond. And then later on, if they do need some money, borrow from the bond, So maybe speak to us about how what red flags we should look for, and what are some of the pitfalls that people normally fall into, depending on their excess bonds.
Sam, excess bonds.
Or maybe before we get there, maybe just explain what is an excess bond before you answer the question. Maybe for someone who doesn't know what is an excess bond.
Yeah. So the whole philosophy around excess bonds has changed a little bit over time, Sam, and it's changed for the better. I know specifically, and I'm speaking about Standard Bank specifically, in the past, your home loan, if you were given an excess bond, that was almost like very similar to a revolving facility, meaning that not only could you access the extra funds that you pay into your bond, but you could also access your monthly installment. And obviously what this led to is that, let's say 15 years later, on my 20-year bond term, my balance is still sitting very much close to what I borrowed 15 years ago. Because obviously any type of revolving loan, the pitfall with something like that is you're always aware that that funds is there. So every little thing, it's so easy just to tap into that facility and move across the funds to your check account to utilize. So yes, in the past, that is how the access bond used to work. That changed quite some time ago, not certain about exactly which year that change came about, but the access bond facility is basically now, how it works is whatever additional funds you pay into your bond, you can then have access to that fund. So you can almost use it like a sort of savings account, for lack of a better word. The positive spin-off of using your access bond as a savings account, because obviously we're not paying that extra funds into our bond with the intention of using it further down the line. But because interest is calculated daily and then compounded monthly, every time you pay extra into your bond, it immediately reduces your monthly interest as well as your bond term. So paying extra into your bond is one of the quickest ways to actually settle your bond faster. And then obviously at the back of your mind, you still have that almost like safety net to say that if something major does happen and you require funds, you can then access that extra funds that you've paid into your bond. Obviously, once you access that funds, the understanding needs to be that you will then be taking your balance higher up and obviously increasing your interest monthly and inadvertently then increasing your bond term, if that makes sense, Sam.
Yes. Sorry, I was on mute. Does make sense. Thank you for the clarification.
I think, you've already touched a bit on, how paying off one's debt can help lower one's credit score. But, in terms of balancing that, the paying off debt, lower, or, some people have often said, if you completely cut off all debt, it has a negative impact on your credit score. Can we just talk about a bit more about that and perhaps more ways of how people can go about improving their credit score in their current situations, and perhaps maybe give us a few scenarios as you did with, how we approach, paying off debt.
Tadeo, just to make sure I'm getting the question right, is the question around how do I improve my credit score?
Yes. So how does one improve their credit score, and does paying off all your debt and closing all your accounts have a negative impact on your credit score?
Okay, yeah. Tricky question. Because, and I suppose the nail, it all depends where you obviously are in your life cycle and basically what you want to achieve. And the reality is, obviously, if I settle all of my debt, obviously all of my unsecured debt, and I close off all of those accounts, it obviously will result in my credit scoring going lower. But then I suppose the question that we need to ask ourselves is, what is the end goal that I have in sight? Because a credit score becomes important when I actually want to borrow money. So if that is my focus, then my focus should be on improving my credit score. But if my focus is on actually becoming debt-free, then the importance of the credit score doesn't weigh so heavily into the equation.
Makes sense. And would you get penalized for kind of checking your credit score a couple of times in a year? Because I do know you said that you are entitled to 1 or 2 in a year of seeing where your credit score is lying. So would I get penalized if I do that more than once or twice in a year?
So Sam, I think let me rather get a very interesting question, but I think I just need to get a little bit more input around that. My gut is saying no, but not 100% certain on that one. Just need to get some clarity on that one.
So I think
not a problem.
I can weigh in. You do get one free credit score or credit report a year, but there are some institutions that charge a small fee if you want more frequent sort of reports. But as Bernice already pointed out, there are other apps and sometimes built-in functions within some of the banks like My360 and things like that, where you actually have a constant view of where you are in terms of your credit rating. So it's not, you won't be penalized as such for getting more than one credit report, but there's one free report, and then after that you pay a small fee.
Right. Awesome. Thanks for that. And I think maybe the last question from my side, I think before we open up for the audience, because I know a lot of people have been requesting and are waiting to ask Bernice some hot questions. From my side, what is your thoughts on, a person who says, I've got this debt, but I also want to invest, right, and grow my money, would that